Hey everyone, in today's video, I want to go through CloudMD because it's been a while. So let's just check how this company is doing. But rather than going through a typical YouTube video where I go through a deep dive on financials, I thought it'd be way more helpful if I went through the exact steps and the process that I go through when analyzing a stock, especially a speculative stock like CloudMD, using CloudMD as an example so that you can make your own financial decisions and do your own critical thinking when picking individual stocks. Now as full disclosure, I do have a position in CloudMD. It's actually quite a very small position compared to the entire size of my portfolio, but I do have skin in the game. I do this purposely so I actually track the company a bit more closely than just watching it on my stock list. So today's video is going to be jam-packed with valuable content. No fluff. We're going to go straight to the goods, okay? So all I ask of you is please smash that like button, and if you have not subscribed to my YouTube channel in Canada, please hit the subscribe button and that bell notification button so you get the latest and greatest videos coming to you. So in today's video, what I'm going to cover is the exact factors that I look for in a speculative stock that are like go, no go, okay? If it doesn't pass these criteria, it is a no-go. Number two, I'm also going to share what exactly I look for in its financials and why. And number three, I'm also going to look for, is there any more potential in this company? What is its upside? Is there any upside left? Whenever I look at a more speculative stock like CloudMD, these are the exact things that I look for. And these are like non-negotiable. Number one, I want to make sure that the CEO is the founder of the company. Number two, I want to make sure that they actually have revenue, okay, sales and revenue in their financials. Number three, I also look for a huge TAM, like a total addressable market that's waiting to be disrupted, or it's a dinosaur TAM that's waiting to be upgraded. Number four, I also look for a growing huge profit margin. Like I can actually see a roadmap, or I know that it's in an industry that has a huge profit margin. Number five, it absolutely has to have a lot of cash and very little debt. Because it's a startup company, I need to see that it can continue to grow without burning a ton of debt, okay? So it has to have enough cash runway to help it accelerate its growth for the foreseeable future. Now, I'm happy to say CloudMD checks all five, which is like, yay! I also really like its business model because it's software as a service, which is a huge scalable market. And by the way, aren't you fed up with the healthcare system? Aren't you sick and tired not being able to see your doctor when you need to over like some little thing like getting a doctor's note to say your massage therapist, or maybe you just have like something that's actually not that critical. You just thought, hey, I really need to see a doctor, but instead of waiting weeks, you could really get your doctor within like even on the same day. This is why I really like the CloudMD business model. I love the fact that the records are being digitized, that I can get a doctor's appointment even on the same day. Now, I know that the virtual doctor appointments are only like one tiny slice of its business model, but this is really a huge reason why I actually like CloudMD. Now, if you want to learn more about CloudMD and its business model, I've covered it in a couple videos up here, so check it out up here. The thing that I do with any company that I look at, I go to investor relations, download its company's presentations, look at the 10K, which is its annual financial filings. And I learn more about the company and its business model and its revenue sources and what its outlook's looking like in the next couple years. So looking at its latest earnings, everything looked pretty good or on track, but there was something in there that just caught my eye. And I think you would really appreciate knowing what that is and why I put a particular emphasis on this key criteria, which is its profit margin. So looking at its latest earnings, everything looks pretty good. It has huge revenue growth, it has a great cash balance. You can see that it has a gross profit margin of 40%, which is pretty good for a software as a service model. You always want to aim for the rule of 40 where the revenue and the cash flow growth is 40%. Now, I know it's gross profit margin, but I think the 40's in there, and that kind of like was, in my mind, made me feel better. And plus its revenue growth is well beyond 40%, which is like, yay! Now, when you dig a little bit deeper and look at the investor's presentation, you can see that has a huge total addressable market, which is the healthcare industry, which is like obviously waiting for massive disruption. I'm sure you would all agree with me on that one. And surprisingly, it also even said a future price target of $4.18. It also gave a forward guidance where it said its future revenue is projected to be around 100 million or 120 million as forward revenue run rate, which is, I think, yep, really good, considering that its revenue is like a lot lower than that, like right now. But although its latest earnings looked pretty positive, there was something in particular that really caught my attention. Okay, the first one is, first, it gave a forward price target of $4.18. So I was just constantly thinking, like, how is it going to get there? Secondly, this is kind of like a red flag to me, and now I actually have to dig a little bit deeper into its financials because its gross profit margin is a significant factor for me, because I really want to see is growing revenue and growing net profit. Okay, in the end, I want to see it to become profitable. So when a company starts dropping its gross profit margin, it's kind of like, why is that? Now, it's all great and dandy when you see huge revenue growth, like in this company, okay, when it has a forward revenue of around 100 to 120 million over the next 2 years, which is like amazing. But we gotta look at what are the costs of sales, what are the expenses, because as much as I see massive revenue growth, the thing that I didn't like was when its gross profit margin has been dropping. So when I dig into the financials, here's what I'm seeing. Okay, compared to last year, it had great revenue growth of around 122%, which is great. But what caught my eye is that the cost of sales and its expenses were growing faster percentage-wise than the revenue growth. So hear me out, okay? It's like saying, hey, you have a bonus. You get a salary bonus of 122%. But you have to move to San Francisco where your cost of living has grown 148%. What do you think about that? Okay, so that's what I'm seeing in this company, okay? Its revenue growth is amazing, but its cost of expenses and its cost of sales is growing faster than the revenue growth, which is a little bit of a red flag to me. Now, I'm not saying this is a trend that's going to continue on, but this is something I'm going to pay particular attention to. So you're probably asking, well, that's great, Tracy. So it's a red flag, but there's no particular trend right now. So is there potential for still massive upside? Because you just told me that there's a big revenue run rate that the CEO said that's around 100 million, which is like a big significant difference from today's revenue. Yes, for sure. So let's check if there's massive upside still with this company. Now, like any speculative stock, especially with a penny stock like CloudMD, it is a volatile beast, okay? This is what, I think this is typically expected with any early stage company. And as you can see from the stock chart, it's been going to like rocketing to all-time highs, and then it drops. Then it kind of rockets back to somewhat of a high, then it drops. This is like super typical. But what caught my attention recently was that it's been in this tight bound, it's been bound range. And I thought, hey, with its recent drop from all-time highs, it got a little bit more appealing, and I want to explain why. Now, remember the CEO recently gave a revenue run rate. Actually, he's been talking about this actually for quite a bit of time, but I'm going to actually use this and compare it to its market cap, because the rule of thumb that I really like paying attention to with any early stage company is its price per sales ratio, which is simply saying, look, according to Investopedia, it's saying that if you have a price per sales ratio that's within 1 to 2, it looks pretty interesting. When it's less than 1, wow, that's super excellent. So with the recent drop in the market cap for CloudMD, it did get a little bit more appealing, where I took a little bit closer look, and that's why I'm making this video for you today, to show you my thought process. So looking at the market cap divided by the revenue run rate of around 100 million, and using the market cap around 391 million, and it's going to date today's video, but that's okay. This is just using this as an example. You can see that the price per sales ratio is dropping, okay? Now, of course, if you use the revenue that's like today, then compared to its market cap, then it's going to look a lot more expensive. But you got to think about this. Are you saying that this company has no more future in the next couple years when it's doing a ton of these acquisitions? Well, obviously not. So that's why I don't like using past revenue, because that's not going to say that's the revenue that you expect in the future. In fact, you're expecting, like what the CEO is saying, is around 100 million. And he's actually said this a few times right now. Now, given its recent market cap drop, because that's what I'm paying a ton of attention to, its market cap compared to its revenue, it definitely makes its price per sales look a little bit more appealing than, say, what it did when it hit all-time highs, okay? But the thing I don't really like what I'm seeing right now, and this is just an early sign, not saying that I'm dissing this company, I'm just saying its gross profit margin has dropped, okay, recently. And its revenue versus its expense growth rate, okay, so looking at the expense growth rate versus the revenue growth rate, the cost of sales and the cost of expenses is growing in a greater percentage than its revenue growth rate. But of course, if we're looking at a potential revenue run rate of 100 million, because it's made a ton of acquisitions, then I'm really going to just like watch it like a hawk when it comes to expenses and its cost of sales growth rate. Because obviously, if its revenue run rate grows like 300%, I really don't want to see its cost of expenses also growing now over 300%. Okay, so this is why I'm saying, yes, it's great that this company's growing, but I really want to see its cost of expenses, cost of sales not grow proportionally. Now, another risk I see is that they've been making a ton of acquisitions, which has been really positive, which is good, because that's the way they will grow. But a thing about that is, how are they going to always get the capital to grow? Okay, as much as they have a lot of cash reserves, which will be used to make acquisitions, they've also been diluting their shares. Now, I totally get it. Being an early stage company, I'm going to say to you, if you invest in an early stage company, especially with speculative stocks, you will always see share dilution. It's super normal. The thing about it is just you want to see it starting to slow down, okay? Because that means that they are able to get their financials in order so that they don't have to dilute their shares to get the capital to make more and more acquisitions. They obviously making enough money within the company that they can actually make these acquisitions. So that's why I keep looking at the gross profit margin. Another risk I see is that with these acquisitions, eventually, you're going to have to start making them all integrated with your software. So I could see a lot of execution risks as they're scaling their software, digitizing all the healthcare records, and doing all that really complicated stuff that they need to do to disrupt the healthcare system with all these pharmacies and the medical facilities and all the acquisitions that they're making. To me, it's going to be like, I'm going to be really watching on how are they managing operations. We won't know until really the next year or so, when we see the fruits of their labor with all these acquisitions, and how do they really handle it. So what am I going to do with CloudMD? Well, I'm going to tell you, I'm still holding on to CloudMD. It's still on my watch list. I'm still watching this like a hawk, where, hey, I'm really keen on looking at the market cap, because if the market cap drops to say 200 million, then it gets even more interesting, because Obviously, with a revenue run rate of 100 million and you have a market cap that's 200 million, then the price per sales ratio is going to get a little bit more interesting, because like I said, between 1 and 2 gets interesting. And then if you get a price per sales ratio of 1, which I saw like 9 months ago, where the market cap was equal to the projected revenue run rate, then of course I'm going to be like way more interested in. So in short answer is, if the market cap is now 100 million, and it has a revenue run rate of 100 million, I mean, I think that is a great sign. But of course, that means that I'm really waiting for the company to potentially drop, which is not probably something you want to hear. But hey, it's a speculative stock. It can do anything in this type of crazy volatile market, especially if there's a huge rotation to value stocks. That means a lot of money is leaving growth stocks. So that could always happen where, hey, when you're investing in a speculative stock, things, really crazy stuff really happens. But here's the upside. Look at where CloudMD is in terms of the S curve. This is like very typical of any, stage of a company. You gotta always check, where do you think this company's at in terms of the S curve? It is really still in its baby infancy stage. So all I can say is, if the company starts executing well and it starts hitting its revenue run rate and it still has ample growth in its revenue growth, and it keeps its expenses and cost of sales like under control, not growing at the same rate as its revenue growth rate, then there is going to be massive upside, and there's going to be actually more opportunity to get into and buying this company when it starts proving its execution. But guess what? Time will only tell. By the way, of course, remember, please do your own due diligence, do your own research, because hey, you don't need to agree with me. I'm just some Canadian YouTuber who loves talking about stocks and real estate investing, and I really would appreciate your feedback about what do you think about CloudMD. Please, if you have any criticism over this video, please also let me know in the comments below, as long as you make it constructive, please, okay? Because I always like to hear other people's opinions. By the way, while you're waiting for the next week's video, be sure to check out these 2 videos up here. By the way, have a great day.